Stocks and shares are the kings of the investment world and have a proven track record of being one of the best ways to grow the value of your money over time. So what are stocks and shares? And why do we invest in them? This is Stocks and Shares Explained by The Simple Economy. The difference between stocks and shares can be a little vague and confusing, so to begin, we will explain the difference between the two. First off, it's important to note that a share is a unit of ownership in a business. It's not just something that goes up or down based on market sentiment. By buying a share, you now own a percentage of a business, and ultimately, over the long term, the success of that business will dictate the success of its shares. So whilst a share represents ownership in a specific business, stocks is a more general term that represents the ownership of several shares in several businesses. So if you said to me, I own shares, I would assume you're talking about one specific company. Whilst if you said, I own stocks, I would assume you're talking more generally about several shares in several companies. Okay, so now we know the difference between stocks and shares, let's explain how shares work with an example. Let's say I set up my own business, Ben's Brollies. After a successful first year, I decide I want to grow and expand the business. However, I need the money to do so. There are two main options available to me. I can either borrow money by issuing bonds, or I can sell ownership in my business by selling shares. As I don't want to take on debt, I decide I'm going to go down the route of selling some of my shares. So as the business owner, I can decide how many shares I divide my company into. I decide to divide it into 10 shares, and currently all 10 of them are owned by me. By choosing to sell shares to raise the money, I avoid taking on debt. However, I will be losing part of my ownership in the process. As I still want to own the majority of the company, I decide to sell just 4 of my 10 shares to the public. 40% of the company will now no longer be owned by me. So why would someone want to buy my shares? Well, if you buy one of the shares in Ben's Brollies, you now own 10% of the company. You own one of the 10 shares. Most importantly, this means you gain exposure to 1/10 of the profit. So if Ben's Brollies makes a profit of £1,000 for the year, you have exposure to £100 of the profit. Now I say exposure because you can't decide to just take that £100 in cash because it's yours. That decision is made by the company's board of directors. They make the decision on what percentage of the profit, if any, will be paid back to you in cash, in what's known as a dividend. They may decide to pay 25% of the profit as a dividend, meaning you receive £25 of the profit and £75 goes back into the business. They may, however, decide to pay no dividend at all and invest all of the profits back into the business. However, just because the money doesn't get paid to you in a dividend, it doesn't mean you're not benefiting from your share of the profit. The profit has gone back into the business to grow it and make it bigger and more successful. Therefore, even though you haven't been paid the money directly through a dividend, your share should benefit through the rise in the share price, assuming the company reinvests the profits wisely. Ultimately, these are the two main ways you will make money from investing in shares. 1, from receiving a dividend from your share of the profits, or 2, selling some of your shares in order to profit from a rise in the share price. So to conclude, for the business owner, the advantage of raising money through shares is that they don't take on debt that they are obligated to pay back. The disadvantage is that their ownership share in the business is reduced. And for the investor, the advantage of shares is that they own part of a business and gain exposure to their share of the profit with no limit on what their potential return could be. The disadvantage is that there is no guarantee that they will make money. If the business collapses, their share is worth nothing. Thank you for watching, and please do leave a comment below if you have any questions, and please do consider subscribing in order to catch the next video.